Hello, and welcome to week two. In week two, we're going to start out by talking about cost. There's a saying that you need to spend money to make money, and that's what cost is all about. When a company wants to sell goods or services, there's an initial cost or investment necessary to get that product or service up and running. Once that good or service is sold, the cost becomes an expense. So if we're going to talk about cost, it's only natural that we also talk about the price that we sell our goods or services for. To help us understand the relationship of cost, expense, and price, I use the example of a lemonade stand, something we're pretty familiar with. So you're starting your lemonade stand, and you kind of know what costs are going to be involved with selling a glass of lemonade. We're not worrying about fixed cost of the actual stand itself or the cost to buy the pitcher to make the lemonade, but we're talking about what's going into each and every glass of lemonade we're going to sell. So we're going to use a simple recipe of just water, sugar, and lemons, and we make a pitcher, and we know about how many cups of lemonade go into each pitcher. From there, we can figure out how much each glass of lemonade is going to cost us to sell. When we actually go and sell the glass of lemonade, the cost of the water, the sugar, and the lemons become an expense. If we take the price per glass of lemonade that we're selling, subtract the expense per glass of lemonade, we come up with our profit for each glass of lemonade that we're selling. Figuring out the cost of what we're selling and then comparing it to the price per unit is one of the most basic concepts of managerial accounting. We're going to talk more about that later in the semester when we talk about cost of goods sold. Next, we're going to talk about accumulating costs. Accumulating costs is the way that costs are measured and recorded. The accounting system typically does this job quite well. When the company receives a phone bill, for example, the bookkeeper records in addition to the telephone expense account and in addition to the liability account, accounts payable. In this way, the cost is accumulated. Assigning costs is the way that a cost is linked to some cost object. A cost object is something for which a company wants to know the cost. For example, of the total phone expense, how much was for the sales department and how much was for manufacturing. Assigning costs tell the company why the money was spent. In this case, cost assignment tells whether the money was spent on phone calls was to support the manufacturing or selling of the product. Managerial accounting systems are structured to measure and assign costs to entities called cost objects. A cost object is any item such as a product, customer, department, project, geographic region, plant, and so on, for which costs are measured and assigned. For the business case on cost objects, we're looking at Delta Airlines, and this could be any major airline carrier out there. When you think about the major costs of their airline, you think about each flight they're going to fly. So maybe they have a specific route that they're going to look at, Newark to Miami nonstop. For that flight, you have the flight crew, you have the airplane itself, maintenance required on the airplane, fuel for getting from Newark to Miami, the ground crew that loads and unloads the plane and directs it out of the hangar. You have rental fees for the hangar. There's all of these different cost objects that the airline can break out. So the question is, which cost is worth tracking? So the book notes that Delta spends about $10 billion annually for jet fuel. That's a major line item for them. So that's worth tracking to figure out how much is going into each flight. And you'll see that they talk about checked baggage fees. And the theory behind that is that the heavier the aircraft is, the more fuel it uses, and there's a cost associated with that. And at some point, some years ago, the airlines decided to pass that cost on to customers. Now in the airline industry, you're seeing charges for premium seating like Economy Plus or First Class. An airline views each seat on the plane as revenue. The idea is to pack the most seats on the plane as humanly possible. But by creating Economy Plus and First Class, they're taking seats off of the plane in favor of legroom or less seats in each row. So the airline likely did managerial accounting calculations for each of those cost objects and decided that it would be more profitable for them to charge more per seat and have less seats on the plane. Costs that can be easily and accurately traced to a cost object are known as direct costs. Some examples are operational labor, supplies and material, and freight. When you think about a direct cost, it's anything that goes in directly to making the good or service that you're selling. An indirect cost, on the other hand, is hard to allocate to a specific unit or product. So here you look at general administrative expenses. So you're thinking central operations like human resources, accounting function, CEO. Their labor doesn't go into directly making the products. You also might think of other indirect costs you have that aren't associated with specific units of production, like rent. No matter how many units of a product you produce or how many services that you sell, your rent is generally a fixed cost. Even if you were to ramp up production and rent additional facilities, it still couldn't be associated with a specific unit of production. The same goes for utilities. Naturally, the more products you produce, the more utilities you use. However, those utilities, by and large, can't be specifically traced back to the units that you're producing. Some other costs in this category include depreciation. When you buy property, plant, or equipment, it's a capital expenditure, meaning that it's going to last beyond one specific reporting period. This is a balance sheet item. And on those items, you report depreciation based on the length of their useful life. Because of that, it can't be specifically attributed to each unit of production. So let's go back to our airline and our Newark to Miami flight. So on that flight, we're paying the pilot, hopefully, the co-pilot, the flight crew, and we know we need fuel for that flight. We need maintenance personnel to attend to the flight while it's on the ground. We need to pay for the air traffic controllers. That's probably the airline paying a fee to the federal government for that. We're probably going to serve a meal on that flight, or I know usually you just get like a bag of chips now or something like that, but there's still a cost associated with that, or any type of beverage service they have. Those are costs directly attributable to each flight. Indirect costs for that flight were the advertising and promotion, the United commercials. Also, the ground crew, whether 100 flights take off that day or 50 flights take off that day, we still need the ground crew there to load luggage on the plane, to direct air traffic on the ground. Again, depreciation on the plane itself, not attributable to a specific flight. Our general and administrative expenses, meaning like the corporate office type of activities, the reservation and sales activities for that flight, and the specific hangar rentals, usually like in New Jersey, the Port Authority runs the airport, and then the airlines pay rental fees to the Port Authority. Those are indirect costs because we can't say specifically that it costs this amount to operate that Newark to Miami flight. We're going to end off this lesson by talking about variable and fixed costs. And we've talked a little bit about this before. A variable cost is directly related to production. As production goes up, variable costs go up. As production goes down, variable costs go down. So what are variable costs? I think the best example here is materials. We're producing a specific product. If we produce more of that product, we need more materials to produce it. If we produce less of that product, we need less materials. Fixed costs, on the other hand, remain constant no matter if our production levels are going up or down. A good example here is rental expense for the factory. Whether we produce 1,000 units or 500 units, our rent for the factory is going to remain the same, and therefore it is a fixed cost. In the next lecture, we're going to talk about determining product cost. See you there.